All right, good afternoon, everyone. Welcome to the session on modernizing financial regulation to facilitate shared economic prosperity. My name is Mike Piwowar. I'm the Executive Director of the Milken Institute Center for Financial Markets, and I'm very pleased to share the stage with three current and one former financial regulator. And why don't we get right into it? Chairman McWilliams, Chairman of the Federal Deposit Insurance Corporation, FDIC. Let's start with you. You were recently named as one of the, quote, America's most aspiring bureaucrats, unquote, by the Wall Street Journal, for a speech you gave in which you talked about your personal experiences and how they shape your work at the FDIC to help more people share the American dream. Please share that story with us.
So I tell people, if you have to be a bureaucrat, you may as well be the most inspiring one. I came to the United States with $500 in my pocket, and I actually came to Stockton, California. So I have to be careful if I mention anything about Southern versus Northern California with Joseph here. But I basically came to the United States thinking that this is the land of opportunity and that the American dream is still alive and well, and I want to partake in that American dream. And I've done a myriad of different jobs. I sold knives door to door. I sold cars in Stockton, California. I closed Blockbuster night shift. Any of you Blockbuster members still? No? Oh yeah. There's one store left. There's one store left apparently. And now I'm the FDIC chairman. Do you want more in between?
That story, right? No, you told a very compelling story at your nomination hearing about your personal story immigrating from Serbia and the experiences your parents had with a banking system that completely failed, and how that drives you now in terms of protecting America's depositors and their deposits.
Thank you. So, and I kept tears back as I was telling the story in my confirmation hearing. So, I basically left the former Yugoslavia when it was still a single country. So, within 6 months of me coming to the United States, my homeland was no more. It became 6 different countries, and the airline I came on was no more. It was Pan Am. And within the couple of next years, the wars basically caused a lot of financial instability in the country, and the banks started closing down. And my father, who had about $2,000 saved in a bank account in former Yugoslavia in Belgrade, got in a line to wait for his money to get it out of the bank. And he got in the line before midnight, and he was nicely dressed, waiting to go into the bank and get his life savings out. And by the time the doors opened, and he was about, I think, 100 or so person in line, there was no money left in the bank. So at the age of 68, he basically went to work as a day laborer, making $5 a day.
Wow. All right, so Director Kraninger, do you have a story that can top that?
I make it a point never to compete with Jelena. That is not a good road to go down.
Can you please tell Joseph that too? Yes.
He hasn't learned that yet. But,
good. So seriously,
yes.
though, you have a distinguished career in public service, and so how your view in terms of working in public service, how is that now helping drive your philosophy and agenda as the new director of the Consumer Financial Protection Bureau, where you're on the job now for 4 months? Is it
4 months? It has been an amazing opportunity, certainly working in D.C. in general and working for the government and public service. While I was not actually born in Eastern Europe or the former Soviet Union, I did serve as a Peace Corps volunteer in Ukraine, and that was fairly formative. I feel very lucky to have been born and raised in this country, because it is still the greatest country in the world. And even as we try to continue to make it better and better every day. But that experience also really taught me that in spades. When you look at the way the economy worked, when you look at the way people look at their government and their relationship to government, that's something that has always inspired me. I was actually in Ukraine when the U.S. was bombing Serbia. And there is a relationship there between, yes, I know. It is. It really influenced me too, because my conversations with Ukrainians, people were worried about the safety of Americans in Ukraine. And the way the Ukrainian people looked at you is, oh, we love Americans. You have nothing to do with what your government is doing. And that really struck me because, again, I grew up believing of government by, of, and for the people. And that's really the way I try to approach my job. I think transparency and the opportunity to have robust public discourse, the opportunity to have these kinds of conversations and make sure the government is actually available to and responsive to the people is pretty important. And that has been a key part of my message in taking over the CFPB and really looking at the way we operate and making sure that we are transparent about what we're doing and why we're doing it. and taking all of the comment that we can and having that discourse is pretty important to me.
Right. So, Comptroller Otting, prior to becoming Comptroller of the Currency, you had a successful banking career. You played significant roles in charitable and community development organizations. How has this experience shaped how you facilitate shared prosperity and think of your job at the OCC?
Yeah. Well, hello everybody. I see a lot of people I know in the audience, so it's nice to be back out west. It's nice to be able to look at the Pacific Ocean as opposed to Capitol Hill every once in a while. So it's a joy to be back. I think being a banker was very formative in my ability to come and become a regulator in Washington. People use often the frame, the other side of the table, but also being regulated by the OCC most of my career, I got a chance to interact with the OCC really on all facets of banking. Always had tremendous admiration for the people and the culture of the organization. And so the opportunity to kind of join that organization, and it confirmed my viewpoint, but just as important, I think I was able to come to Washington with some clear things that I thought that we could make banking and communities across America better. And one of the big initiatives that I have been focused on is the Community Reinvestment Act. And I'm excited. I think there's a lot of momentum in Washington to be able to move that forward. This is a provision that was established in 1977. It was really intended for banks to be able to serve the communities to which they operate. Since 1977, we've gone, digital banking, we've gone to interstate banking, and I really think there are kind of four things that I think we can do to make a difference. We can better define what counts for CRA. I think we can do a better job of defining where it counts. I think we should also define what counts, and then we can accumulate what is being done across the banking industry today and be able to track that and see the direction. And what influenced me the most is when I was living in this community, and I lived in this community for about 25 years, I got a chance to go to organizations like Operation Hope and the Hollenbeck Community Center, and be part of Junior Achievements Finance Park, where people from inner city America were coming into these and looking for guidance and mentors and counseling on finance, and that shaped my life really about that. I think we can do more. I think not only is the government, but the banking industry to close this income disparity and wealth gap that we have in America today. And I really might commend the Milken organization for making that one of the key bench points of this conference, because when smart people start talking about things like this and bringing capital and ideas together, I think we can bring solutions to that. So thank you for allowing me to be here.
Great, thank you. So Gene Ludwig, you were a former comptroller of the currency. You are now advising companies that are subject to the regulations for the folks on the panel here. Do you want to say a big thank you to them for that? But you've had a long-standing commitment to making sure that financial regulation serves in particular the needs of small-town America. What do you mean by that, and how does that drive what your actions?
Well, the United States is really blessed by having community institutions. We have the largest number and largest percentage of community banking organizations in the whole world, and they serve a really important function. My dad was a country doctor and a son of an immigrant, and worked his way up from a steel mill, and got paid in chickens and sometimes eggs. But the community banker in that community made a huge difference in his life and his medical practice, as it did for the community generally. If we don't focus on that sector, we will lose one of America's great strengths, which keeps us diverse and it keeps us inventive and entrepreneurial. And in that regard, Mike, I want to commend the sitting regulators here with me today, because each of them are focusing on modernizing the regulations, which is the subject of this panel, and they're doing a really hard job and an important job, making sure that regulation is effective on the one hand, but really efficient and serves the needs of the people and the institutions we're dealing with is incredibly important. If you take a huge law and you're in a community bank, the person who's got to read that law is the CEO. He only or she has so much time and in the day to basically do their job and also obey the law. And if we have piles of regulations on regulation that actually is too old, hasn't been looked at, is inefficient, it really gums down the ability of the system to function, particularly for community and regional organizations. And so what the sitting regulators here are doing, which is reviewing these laws and regulations to make sure that they are as efficient and as effective as they could be, is incredibly important for the well-being of the country and for keeping this vibrant community banking sector.
Right, so let's piggyback off of that. So, Gene mentioned you all are looking at a number of the regulations that are on the books currently. The Treasury Department, in a series of reports, identified potential changes to legislation and regulation to try to modernize the regulations that were out there to try to make them, among other things, make them effective, efficient, and appropriately tailored for small institutions versus larger institutions. Can you give us some insights into terms of what types of things are you looking at? What types of regulations in particular are you looking at? And how do we know that, in fact, it's not working for maybe the smaller institutions?
Sure. So I had an opportunity to work at a large regional bank for about 18 months. And when I first came to the FDIC, when we were looking at different burdens that our regulations impose on smaller financial institutions, I said, well, what does their chief risk officer think? And the staff around the table looked at me and said, they don't have a chief risk officer. And I was like, they don't have a chief risk officer? What does that mean? Well, they have a chief lending officer who's also the COO and also the front desk teller at some time. And so when we look at regulations, we need to understand there's a real cost to this. And people often talk about deregulating. Deregulation is not, it's not a dirty word, but deregulation for the sake of deregulation is something we're not trying to do. We're trying to smartly tailor regulations and be able to relieve some of the burden on these small financial institutions. I'm doing a nationwide listening tour. I'm going to every state in the country to basically meet with the bankers and, where possible, with consumer groups.
Every state?
Every state in the country. Some of you live far away, let me just tell you. It takes about 2 or 3 flight changes. But meeting with, I'm about 14, 15 states in. By the end of the summer, about 22, 23 states in. And just trying to get the feedback from the folks on the ground, going to rural communities and saying, what's bothering you here? Trying to meet with banks' customers as well and saying, are you getting the credit needs that you need? Are your credit needs satisfied? Are you getting access to credit? And how's your relationship with your bank? And you learn a lot when you go over the what people like to call the flyover America. You learn that, I had to learn the life cycle of corn, because our farmers actually provide financial services to farmers. Our bankers do, and so understanding how farmers are doing their business of farming is, and seasonality of it is a huge deal. So at the FDIC, we're trying to take a look at everything that has been outdated or unnecessary or duplicative. And a part of that effort is I asked, in how many ways do we communicate with financial institutions exactly for the reasons that Gene outlined? The CEO is quite often reading these stacks and stacks of regulations. And so just by asking, do we ever archive stuff? Do we ever archive regulations? We were able to reduce about 60% of the financial institution letters, which are our directives for banks how to manage their business of banking.
So, Director Kraninger, if I remember correctly, you're engaging in a listening tour as well.
Are you going to every single state?
Yeah, every.
I'm going to hit my 50th state at the end of the month, so I'm excited about that. Personally speaking, not as director. But at some point, yes, we will definitely hit as many states as we can. I truly believe in what Yelena was talking about in terms of getting out and actually talking to people who are affected. The listening tour that Mike mentioned is the one that I did just starting the position. I took the first 3 months to say, what for the stakeholders across, there are a lot of opinions about what the CFPB does, what it should do, how it does what it does. And I got the opportunity to talk to, I went to a military base and talked to the every level of military personnel that were there and family service members. I've talked to faith leaders. I've talked to the employees of the Bureau out in the field and in the regional offices, institutions of all sizes, banks and non-banks, and community banks and credit unions. Because while we involve our responsibilities at the CFPB really do cover the gambit. When it comes to regulation, we do have an impact on even smaller institutions with our regulatory responsibilities. We supervise banks and credit unions at 10 billion and above, and non-banks in those larger participant arenas that we supervise. And then we have pretty broad enforcement authority as well. So talking to them about their interactions with the Bureau and understanding that, I've come to a real point where we're going forward now thinking about starting first of all with the consumer, him or herself, and our education mission. And so trying to make sure that we're empowering consumers to be informed, to be making the best decisions they can in the marketplace. With respect to regulation, I know there's a lot of interest in this space, particularly in the mortgage space. We have a housing finance conversation coming up. But talking about really the tremendous number of regulations that changed in the wake of the financial crisis, many of them coming out of the CFPB. We had a responsibility under law to put a number of those regulations out, but now we're in the position 5 years later of having to assess those rules. The Dodd-Frank Act actually gave us that responsibility. It's a little bit unique, but to literally look at the rules that we put out and 5 years later say, were they actually effective and did they have the impact that was intended at the time that the regulation was released? We've done a few of those reports. We have a few more to go on TRID upcoming. But the challenge there, too, is just the way the regulatory work is set up. It's an assessment of each rule individually. Well, to the point that was made here in terms of the impact on smaller community banks, smaller credit unions, the compilation of those regulations together had a tremendous impact. But as we look at them individually, it's a little harder to assess whether the costs and benefits actually make sense individually. And so we are really doing the work of going through comments we've gotten across the board. Last year, many of you probably know that Acting Director Mulvaney did a call for evidence, asking for all of the comments out from on a myriad of things that the Bureau does and how we do it. And we got 1,750 unique issues and ideas related to regulation, and trying to pour through where, again, we're going to get the best bang for the buck in terms of reducing that burden. And the other thing that I've really been focused on and talking about is not so much how that impacts institutions. My job is protecting consumers. I want to make sure that we're defining that in a way that consumers can understand how that impact on an institution actually affects them in terms of access to credit and cost of credit. So again, when we're looking at the cost of the regulations or the impact of regulations, it has to be from that lens, and that opportunity to communicate in that way and really analyze in that way, I think, is important too.
Hey, yeah, you bring up a number of important points. One of them that really resonated with me in my prior role as a government official was the fact that the agencies are pretty good on an individual basis doing sort of cost-benefit analysis, but it's really the cumulative effect. And I don't think people fully appreciate the amount of additional regulation in the financial sector that came after Dodd-Frank, right? And some people can, we have it on our minds, 2,319 pages in Dodd-Frank, but what did it really do? It really told the regulators promulgate 400 new rules across the different agencies. Think about that. In a 10-year period, 400 new rules and regulations. And it's on the one hand, you can look at each individual rule, but it's really that cumulative effect on the chief lending officer / chief risk officer / teller / all those other sorts of things. So it's very heartening to hear that you all are taking that approach and going to that. Gene, I want to turn to you. Earlier, Director Otting mentioned the Community Reinvestment Act, which was a law that was originally passed in 1977, and it was Congress's attempt to, it was sort of the government's attempt to think about economic shared prosperity within financial regulation. And what it did was it was designed to encourage banks to meet the needs of borrowers in all segments of their communities, including low and moderate income neighborhoods. And it was originally passed in 1977, and it's gone through a number of different regulatory amendments and legislative amendments. And when you were Comptroller of the Currency in the 1990s, it went through a number of those amendments in there. Can you give us a little bit of a historical perspective in terms of what was working well as intended, what was not working so well as intended, lead us up to today, and then I'll talk to the current banking regulators in terms of what you all think needs to be modernized in terms of regulatory or in the legislative respect to CRA.
Well, Mike, this is an enormously important law and set of rules. The CRA makes an enormous difference in terms of low and moderate income people in this country. And but like any statute, particularly dealing with a big nation complexity, in order to get it to work, it takes a lot of doing. But by the time I took office in 1993, the law passed in 77, there were things that were going on, good-hearted attempts, but it was really much more about paperwork than it was about actual accomplishment. And so there were complaints on both sides. The community groups complained that not enough was happening, and the banks complained that all this is a lot of paperwork burden and it gets in the way of our doing things. And so we set about doing, maybe not 50 states, but along the lines that Director Croninger said and Chairman McWilliams, we went around the country with serious hearings. I think we did 8 of them with the regulatory agencies involved, the FDIC, the Fed, and I did for the OCC together. And we learned a lot. And we made the best effort we could as a joint group to lower burden and increase effectiveness. And it worked. Well, one of the things that we learned was that you can't do it just one time. And so the rules we put in place said that every 5 years they should be reviewed, because we recognized at the time that the world was going to change and a static set of regulations wouldn't work. Now, having said that, I don't mean to commend everybody here, they all deserve it, but I particularly want to commend the comptroller because what Joseph has done here is really very, very important. The speed of change in the regulatory community, in the world, which is reflected in sort of changes in regulation, has just been tremendous. And so even an every 5-year review right now is not enough to make these important rules effective in today's day and age. And the changes that he and the rest of the regulatory community are responsibly looking at can make an enormous difference, again, in really increasing the effectiveness of this incredibly important set of rules and also making it less burdensome where it need not be. So I thought Chairman McWilliams said it best. This isn't about deregulation, it's about smart regulation, and that's what I think they're focused on. Here, this is an incredibly challenging task to take on, and that's one of the reasons I really want to commend Joseph, because you've got, warring factions, right? You've got community groups that all they care about is more lending, more support for the communities, and you've got financial institutions that do care about their communities, but on the other hand, doing this is a lot of work. Getting that to mesh in a way that you survive the process, I can tell you, is no mean feat. And so to take this on voluntarily, as he's done, is a really big deal and can do immense good for America.
So with that, Comptroller Otting, so you sort of previewed some of the high-level issues that you think needs to be taken care of in CRA, and Jean highlighted the fact that the world is rapidly changing. We have changes in technology. We have the growth of FinTech, which we'll get into in more detail in just a few minutes. But when you think of digitization and other things, like what does even the definition of community mean nowadays, right? It was sort of location, geographic based, and that sort of stuff. What are some of the challenges that you're facing, and maybe hit on some of the fact that you've got some arrows that are pointed at you and from various groups that are there and taking on this.
Yeah, first of all, if I may, I'd just like to take a minute and just comment on the regulatory environment for people. In Washington, there are very few things that have bipartisan support in the world today. And I would tell you support of the community banks is one of those ones that cuts across both sides of the aisle. And I think probably one of the most monumental things that happened in the last Congress was Senator Crapo's ability to open up the lockbox, so to speak, of the Dodd-Frank and be able to look at things where community banks were significantly negatively impacted, and be able to pick out about 25 or 26 things, 20 of those that impact the OCC, where we were required to go in and change certain rules to the benefit predominantly of banks that are $10 billion or less. I really find great admiration for him that he would be able to get bipartisan support and do that. All of the regulatory agencies are working at warp speed to be able to put those rules in place. We started that process in the third quarter of last year. We hope to have it done by the fourth quarter of this year. And that will be up to 25 rules that will have interagency impact. And I think that will have monumental impacts of community banks' ability to survive. The other side of that is there's been a strong desire to look at things like the capital structure and the liquidity structure, which is a far more complicated thing to look at and say, how do you tailor that? And you hear the word tailor a lot, of tailoring for the risk of the in size of the organization. And so we've worked on that a lot. And then, quite frankly, there are still some rules left unwritten from Dodd-Frank, like the executive compensation that we hope as a group to be able to take that on this year and put forth some kind of notice of proposed rulemaking. So there is an enormous amount of work. And I would tell you, one of the hardest things that I found coming to Washington is this interagency rulemaking, to be honest with you, because generally you have three fairly strong-headed groups that feel that things should be done a particular way, and bringing all that together, getting it on paper, getting it out, putting it out for public comments, and then bringing it back and then writing a final rule is almost a Herculean task in itself. So, but I can tell you it's very nice to have colleagues of mine in the other agencies that are willing to do whatever it's going to take to be able to move that stuff through the process.
He's only saying that because I'm right next to him.
As far as CRA, first of all, I would like to say anybody who feels that we are weakening CRA is either misinformed or is economically advantaged by the current structure and does not want to see change. I would tell you, we have spent an enormous amount of time talking about CRA, and it's our viewpoint, there's about $500 million that gets spent every year by the banks in CRA. It is our belief that could increase by 25 or 30% if we gave banks the vision about how they could do more in communities across America and get credit for that and have a measurement system in place. So I do feel that people who are saying that the regulators are trying to gut CRA really don't understand what we're trying to do. And I think as people become more informed, then they get excited about it. And I can tell you, I have spent an enormous amount of time, before we issued the advance notice of proposed rulemaking, I met with over 1,000 people, community groups, civil rights organizations, nonprofits, banks, associations, to talk about what should CRA look like. And then after we put the AMPR out, we got 1,500 comments on it. So this is, and to put that in the proper framework, we normally put a rule out, and if we get 100 comments, it's a big number. So it just tells you the interest in this. And so there are certain things you get a one shot in life to do, and I really believe this is our shot to be able to fix CRA. And I would tell you banks want to do more. And I don't want to get into the details too much, but I think if I told you, go do something, but I'm not going to tell you how we're going to measure it until we show up for an exam, you would be confused. If we told you, make the investments in the loans and we'll tell you 3 years from now if they qualify for CRA, you probably wouldn't be excited about that. If we told you, you can do stuff in your assessment area, and if you get a satisfactory rating, we'll let you do stuff in other areas, but we'll tell you 3 years later what that is, I don't think you would be excited about doing anything that's unique and creative. And I do think that we have a once-in-a-lifetime opportunity to do this.
I might say what you're doing here just can have such a meaningful impact on our communities. So when I did the reform in 1993-94, it was $17 billion a year of lending going into low and moderate income areas. When the reforms were over, it was $450 billion a year. Your ability to transform from 500 to 800, this is an enormous pop for low and moderate income America. And so there are a few things I think one can do in government that can have that kind of an impact on really our most disadvantaged populations. But it is hard work, and it's got to be granular and also reflect this tremendously changing financial picture we're living.
Good. Chairman McWilliams, you want to?
I'll just add from my personal experience, when we talk about LMI communities, there's that phrase, LMI, low and moderate income communities. And the truth of the matter is that these are people we're trying to actually help. And making sure that the banks, under the original act, can basically serve their communities in which they function. And the question then becomes, well, what are their communities now that we have digital banking? My daughter is 17 and she's still laughing at me every time I take a picture of my check to deposit. I'm like, so cool. So cool. And no longer do you even have to press a button to take a picture. The camera just goes, whoop. I'm like, wow, so cool. And so when we think about how the world of banking has changed and the digital channels and what is now a community, you talk about what's a community bank. What's a community, right? For a digital bank, for a bank that has a predominantly digital footprint, for a bank that may have folks with residences in a place where they don't have branches. What does that mean? What's there? So giving more clarity on what's an assessment area, giving more clarity on what qualifies, seeing if there's an opportunity and a perspective that we can provide for investments in minority depository institutions to qualify more so for CRA credit in small businesses. I mean, there are a lot of things we can do that would actually have a meaningful impact on the community. And these banks in general, like Joseph, I found out in my discussions, they actually want to have a meaningful impact on their communities.
Good. So before you mentioned sort of FinTech stuff, and I'm going to get to that in a second, but I want to talk about something that Joseph mentioned, Comptroller Otting mentioned, was the interagency rulemaking, about how difficult that is, right? Not only for the regulators, so a lot of people don't realize this, there's a lot of Dodd-Frank mandated rulemakings that require the regulators to get together and come up with joint rulemaking, and you have entities out there that are subject to multiple regulators that are out there, and I didn't appreciate the fact on the compliance side, for the firms that have to comply with this stuff, who do they call to get the question, right? It's a rulemaking that's written by 5 different agencies. Do they call the FDIC, the OCC, the CFPB, or those sort of things?
Always the OCC.
Always the OCC.
No, absolutely not. That's if you want to get a no from an answer.
Hear that? So let me turn to FinTech, right? So financial technology, right? So a few years ago, FinTech wasn't even a thing, and now it's one of these big buzz terms. But it really is something that's sort of transforming a lot of the financial services sector, and also the way in which the regulators have to think about it. And last July, the Treasury Department put out the 4th in a series of reports that it did consistent with the core principles executive order that the President had put out the previous year, looking at non-bank financial institutions, FinTech, and innovation. And in that report, it challenged the regulators to be more forward-leaning and more forward-looking in terms of thinking about how financial technology, there are potential opportunities that are out there, there's potential risks that are out there, and the fact that it's changing a lot of things. And I know that each of your agencies has implemented a number of mechanisms to try to be more forward-leaning and to think about these issues. So Director Kraninger, let me start with you. The CFPB, I know, has an Office of Innovation. Could you tell us a little bit about the work of that office and Project Sandbox and some of the issues that you're looking at?
Absolutely. I got the opportunity to have a former state-level innovator. So Paul Watkins, who some of you probably know, came to the CFPB to run our Office of Innovation. And we really have a small but very dedicated group of people that are focused on these issues. In the last, I guess he's probably been here a little less than a year, but in that time period, we've put out a few policies that got a lot of comments back. One is certainly our trial disclosure policy, and trying to look at the opportunities really to, again, give consumers better information in a simpler, more succinct way, more creative way. So I'm particularly excited about the opportunities there. On the trial disclosure policy, we're pouring through those comments and trying to cobble together what will be a final policy position there. Also on the Project Sandbox too, we have great comments there, and looking at the opportunities for, frankly, innovation to really help with access issues. We know that we have as we've talked about at this conference with shared prosperity as a goal and an interest, the underserved community, and that encompasses a lot of different kinds of people, but certainly we still have immigrant populations in this country who do not interact with the banking system, and given their histories, they don't feel that they really understand how to do that, and figuring out how we can use technology really to reach many people who have been underserved in this arena. So there's a lot of opportunity there. There is concern about the risks. We've had that conversation with a lot of the community advocates who are starting to, I think, be a little more forceful in talking about the risks. And I am hoping that we can continue to have this conversation as a bipartisan conversation, realistic about the risks, but also looking for those opportunities and really seeing what can come with innovation and giving, frankly, the opportunity for innovators to participate. This is an incredibly challenging regulatory landscape, as we said, with respect to the way the United States set up its financial regulatory framework. So for in a fintech company that actually wants to come to the government, which is, I think, contrary to your culture. I won't speak for Silicon Valley, but it's contrary to the culture to want to come into the government and say, here's my idea, help me figure out how to comply with the regulatory landscape, or help me figure out how I can fit into that regulatory landscape. And that's the way we're setting up our policy and thinking about it. Again, you start with an entity that actually voluntarily is coming forward, trying to figure out how they can fit in and how they can comply. So a lot of issues to work through. I don't have any news to make on where we are on the policies, but we're definitely making a lot of progress and want to have that conversation on a continuing basis as to how we can help facilitate this. And so some exciting things on that front. We did lead the way in joining GFIN, so we are actually having the international conversation with UK and Singapore.
So for folks, GFIN is the Global Financial Innovation Network, right?
Yes, exactly. So comparing having government entities who are working in this space, comparing notes on what's happening out there across the country, because it is happening here and across the globe. So we have some great ideas that we're getting from our partners and looking at opportunities there. And actually, the CFPB is looking to do something like GFIN in the U.S. Because what we're contending with as well is state regulators, obviously, who have a role in this space and trying to figure out how that all fits together. So we're looking to, and have done, and Paul in particular has done a lot of outreach to the state regulators and state attorneys general to say, how can we come together and look at this? A number of the states have actually passed legislation to look at innovation as well, and what they can do to help facilitate that. So we're very engaged in the conversation and very much appreciate those who gave us comments on what the opportunity is as they saw it.
Yeah, so you bring a very good point. The fact, not only do we have fragmentation at the federal level of regulation in the United States, we also have state-based regulation. And for these new startup firms to try to navigate that, and a lot of them, so many of them want to try to comply with this stuff, and it's sort of very difficult. It's amazing to me, when you travel the world and you look at the regulatory environments for the financial sector, most jurisdictions around the world are debating between whether they want a single peak model of financial regulation where you have one single regulator that deals with all financial regulation, or a twin peaks model where you have one prudential or banking regulator and then you have one markets regulator, right? In the United States, we have what I like to call the rolling hills model of regulation, right? We have 3 banking regulators, we have 2 markets regulators, we have the CFPB, we have the FHFA, Financial Housing Finance Authority, we have a number of other various, and then you have all the state level regulations there. And in insurance, we don't even have any federal regulator, it's all state-based stuff. So very, very difficult for these folks. Chairman McWilliams, can you talk about what the FDIC is doing in innovation?
FinTech. So I want to dispel the myth that people talk about FinTechs as something new. Financial technology and innovation have been around since probably the Medici set up, the banking system as we know it today. And so what has happened, unfortunately, in the last decade or so is that our regulatory framework has not been agile enough to respond to innovation at the same speed as we have been able to innovate. So we have now all of these companies that are actually inventing and doing a lot of entrepreneurship with the financial services products and offerings outside of the banks. And they're very agile. They can do a lot of stuff that banks used to do in terms of attracting customers. And we're talking about shared prosperity at this conference. The truth of the matter is that a lot of the banking services that have left the banks are now being done by non-banks, are reaching out to folks who are unbanked, underbanked, folks who don't have a typical credit score or don't have enough data to be put into the credit score for the traditional underwriting purposes. And as we think through all of these issues from a regulatory perspective, we think about financial innovation through 2 different lenses. One is inward, one is outward. And the inward lens is how can we use technology at the FDIC to better supervise and modernize our supervision process. If you remember, I mean, the FDIC was set up in the 30s, you know, the OCC 1850s, right?
1860.
60s. I thought you were older. So it's one of those things that as we try to modernize our systems and our processes, we're still dealing with stuff that's, you know, a century, in some cases century plus old. So we need to adjust internally how we look in technology and how can we utilize technology to help community banks, you know, and your father's banker in a small community to better comply and compensate for some of the economies of scale that don't work to that bank's advantage. And then the outward-looking thing is that we need to focus on how can we utilize technology and allow banks to innovate and allow banks to either innovate internally or partner up with fintechs and allow for the regulatory framework to be open to that. And if you really talk about, you know, how do banks expand their customer base, there are two main ways. One is that they can acquire customers from another bank, either by acquiring the bank, the portfolio, luring customers with nice offers for new checking accounts. And all of those ways are very expensive. The cheaper way is for a bank to go and reach the underbanked and unbanked and bring them into the banking fold. And to do that, they need to be innovative in how they reach those communities and how they attract them into the fold. So a lot of the thinking kind of about financial technology and fintechs and innovation in this space is about how can we help banks reach into the unbanked, underbanked, the low and moderate income communities, put them into the banking system and make them prosper through the banking system and the financial services system. And I can tell you from my personal experience, on my second day in the United States, I opened up a checking account at a bank, and then I realized I needed a credit card. And so I had $500 to my name, and I tried to apply for a credit card, but I was what the regulators like to call ninjas: no income, no job, no assets. And but I still thought I should get a credit card. And so I got a secured card, and I sent $500. I think actually I sent $300 to a bank to get a secured card. And now I had to explain over the phone to my dad, who remember just lost all of his money, that I sent my money to a bank that is charging me interest, that holds my money, and that I pay back that bank on my own money every month. And somehow this made sense in the United States of America. And I think he probably looked at my mom and said, "This is your fault." But somehow that secured card led to an unsecured card, to, you know, a high FICO score, to not to brag, but, you know, to buying a house, to being able to buy a car, to being able to be a part of the financial system. So as we think about technology, we need to be able to think about how are banks offering these products and reaching to the customers that are generally not in the banking fold.
Comptroller Otting.
Yeah. First of all, Tom Curry, the 30th comptroller, is sitting in the front row. And Tom, thanks for being here. But
we have two comptrollers keeping an eye on you.
That's right. Actually, three myself, too. But the thing I would commend Tom is about 5 years ago, Tom started the Office of Innovation at the OCC. And it really was the nucleus for incoming, you know, flights of people inquiring about what it took to become a bank. And I think when Tom started that journey, there were probably 250 fintechs that thought they wanted to be banks, and then they would come visit the OCC and they would hear things about capital and liquidity and risk management and policy and procedures. And I kid, you know, they often led skid marks leaving the building, because that was exactly the opposite of what fintechs were about. They were disruption, quick to market, solving solutions, and all those things. But what happened with a lot of those entities said, well, we now know we don't want to be a bank, but we want to partner with banks. And the Office of Innovation was able to start to share what that journey is like to be a supplier to a bank. But in conjunction with that, Tom also began the process of looking at what it would take to be a national fintech bank or a special charter bank. And under his leadership for well over a year, they analyzed the situation. When I got to the OCC in November 2017, we took a hard look at it and tried to think through all the characteristics that were necessary. And then in 2018, in July of 2018, we announced that we would entertain applications for a fintech to be a national bank charter. And if anybody knows anything about a bank, you know, charter, it takes, you know, somewhere between 9 and 12 months to complete that process. We do have expectations that a number of entities will file for that charter this quarter. And we're highly encouraged by the type of entities that we're seeing that will pursue fintech space. I would say it fits into two kind of buckets. It's really small ticket consumer and business lending. is one aspect, and the other is custody of all different kinds are having dialogue. And most of the lending functions are entities that have been operating for a number of years. But they run into the issue of, if I want to operate across multiple states, a state banking charter with multiple rules in every state is too complex. And the national banking charter gives them a broad umbrella how to operate. I would say, for the record, we support both the state banking system and the national banking system. We have from day one, and we're respectful of that. And if a bank wants to be in just a few states, then the state banking system might be best for them. But we also think that they should get the option, if they want to operate on a much broader scale. And I do think, if you really think about the banking industry, and Yelena touched on, banks have been fintechs, if you really think about it. Think about ATMs that got introduced in 1980, and then online banking and bill paying, and then mobile banking. Banks have continued to introduce technology for their customers. But I do think we have a real breakthrough that we have the ability to experience, where these fintechs are going to help people the way they communicate with their customers, how they offer new products and services, or how they acquire new customers. And one small example that I give is 6 months ago, I was looking for a new pair of running Nike shoes. And so I went on board and typed in Nike running shoes, 10.5 black. And then I got busy and I wasn't able to buy those. But what happened the next 20 times I went online? There were those black Nike shoes. And finally I bought them. And I think, ability for banks.
Your office tries to help customers look at it.
Ability for banks to enter that space where they can anticipate your need and be able to provide a service to you is probably the next big lever that we'll see in the financial services practice. So.
Good. So Gene, you now advise a number of clients who are subject to the regulations. Are you seeing a more agile approach in the approach to innovation and FinTech?
Well, FinTech is really the ability of banks to adopt it is going to be a critical determinant of whether the banking system, the legacy banking system as we know it, will be relevant in the next decade. We're at a time in history, a great flexion point, and there are a couple things that go into the equation. One is regulation and the ability, to adopt these changes in a timely fashion. In that regard, one thing, Mike, I wanted to say is that, the comment that Chairman McWilliam made is important. The issue is not deregulation, but smart regulation. And your comment about how many regulators doing the same thing, Mike, is an enormously important point. Most people don't understand that regulation that we see today is not scientific. It was what people thought was the best thing they could do. And we have a responsibility, it seems to me, in a particularly modern age, to go back and look at this and say, well, what really is effective? And we just went through a huge financial crisis. We had lots of regulations. We had all these lots of regulations. Why weren't they effective? And so, particularly now, because there isn't a lot of time, to both allow financial institutions to get into these new technologies, and on the one hand, and on the other hand, to be able to do so safely. So big challenge for the regulators up here today. And let me say one thing about the technology environment in which we live and how it's changing, both the environment in which banks are operating and also the need for using technologies to get ahead of them. If you look around the world, there are a number of situations where banks have, harm consumers, often inadvertently. But what happens today is once there's a harm to a consumer, somebody gets online, it gets into a chat room, the internet takes over, and all of a sudden it becomes a huge global issue. If you look at Australia, for example, two of their largest institutions, they only really have 4 large institutions, they fired both CEOs, the government, and fired both chairmen. Are these banks all of a sudden crooked? Did they all of a sudden decide now's the time? No, things have gotten more complex. They did violate rules and violate consumer rights, but it became such an explosive situation before they could really handle it themselves. And that's what we're going to be seeing. This is kind of almost a global disease because of the nature of new technologies. On the other hand, a lot of these institutions don't have the technologies in a large, complex environment to actually identify the problems, understand them at the C-suite and the boardroom to take care of them, and then actually deal with them. So, it's sort of a tale of two woes. On the one hand, the enormous explosive potential harm that these technologies can cause a financial institution, good sometimes for consumers, but explosive harm. And on the other hand, the need to rapidly innovate so that you can actually stop the problems before they happen in your own institution and then deal with them. One, we've got to deregulate, again, wrong word, smart regulate, so institutions can adopt these technologies and utilize them in a safe way. And two, these institutions are going to have to employ these, as are the regulators, in order to deal with a much more complex world that itself is being driven by this technological change.
Yeah, so Gene, you mentioned, so stopping problems before they happen, right? So one of the often repeated but wrong ways to measure the effectiveness of a regulatory agency is the number of enforcement actions, right, going after. And we saw in the wake of the financial crisis, obviously you're going to have a wave of enforcement actions, right? And in some places in Washington, D.C., the attitude was, the beatings will continue until morale improves. And I think we've sort of gotten past that, and we now have regulators that are taking more of a proactive approach, right? It's not just the number of enforcement actions, it's how do you actually prevent things before they happen. Some of it is making sure that you have the compliance folks that are in there and those sorts of things, but also the other is to have an educated consumer, an educated person. The government can't be everywhere at all times. And I know all of you in your agencies have a number of efforts, both on the compliance side to make sure you stop problems before they happen, but also in the education efforts. I'm wondering if you can speak about some of the initiatives that you all have. Kathy, I know Director Craner, you've talked about those. Who do you want?
Yes. Yes, I have made prevention of harm kind of the focal point for the direction of the agency going forward. I think to Mike's point, the agency did very much, and I won't criticize it. I understand why it was done, but it's not the path I want to take us forward, is really that those enforcement actions were big headline grabbers. And from my vantage point, we want to be ahead of the issue here. Again, the job is to protect consumers. The job is to, frankly, work much more productively with a number of the institutions that largely, by and large, have their customers' interests in mind, and they are actually trying to run a good business that attracts more customers. And so understanding that dynamic and looking at the opportunities to work productively with them through supervision is the path that I'm taking. So we're doing a very deep dive and assessment on the way the CFPB does examinations and working with the institutions in a productive way to frankly encourage that self-examination, that self-identification and remediation, because there is sometimes a very long road once you have to use that enforcement tool to actually helping the consumer and getting them some remedy or restitution for the harm that was done. So trying to prevent that up front, trying to work with institutions productively. And to Mike's point, certainly the starting point is education. Giving consumers the tools that they need to understand how to make the best decisions possible for themselves and their families is something that we're really focused on at the Bureau. Congress gave that as a primary mission to the CFPB. So we're working hard on that front. And frankly, too, to try to be unique, providing a niche service in that arena. I think actually Mike Milken said this the other day. There is a lot of activity in the financial education space and financial literacy space. I've said there's a lot of investment in that space, but what are we doing that's actually going to move the needle? And the charge that I have taken on and that I know my colleagues share is looking at savings and emergency savings, trying to figure out what we can do to actually change behavior on that front and reach people when they need the information the most in terms of what they can do to take over, frankly, and take on the financial empowerment in their own lives as to how they can approach savings, how they can approach getting control of their finances and understanding them better. And so the CFPB has done a lot of work on trying to define financial well-being and trying to look at what is actually working in the world of promoting savings and frankly in partnership. As I said, there are so many entities out there doing work in this space. I think the opportunities to partner with employers. There are a lot of big employers that are actually thinking about this as well and looking at opportunities to offer their employees a lot of different products and services in this area. And so that's something that I am very much interested in, and I know I have a lot of other entities that want to partner on this to do what we can to move the needle on particularly emergency savings.
And the banking agencies?
You want to go first?
No, go ahead.
I can be kind for a second.
Okay.
So at least at the FDIC, we have the so-called Money Smart program, and it's a long existing curriculum where you can download different training brochures and materials, and we have some for older adults, we have some for kids, for high school students, for regular adults. And so we look at education as a critical component of the system, and at some point in my career, I think about 10 years ago, I did a survey of how many federally funded financial literacy programs we have. And at that point in time, I don't know if the number is still the same, but there were 56 federally funded financial literacy programs. So if you think about a tremendous investment of resources in this area, and yet we have a general population that's unable to tell you the difference between the interest rate and the annual percentage rate. And so then you have to start thinking about what are we doing right and what are we not doing right, and what solutions are working and not working. Well, I would like to think that the FDIC's financial literacy program is one of the best. The truth of the matter is there's probably more to be done here, but more focused, because 56, and yet we have an uneducated population to a large extent. And with respect to enforcement actions, I look at them in this way. If we have to bring an enforcement action, both the company and we have failed. And we have failed for two reasons. One is that we probably didn't spot the issue early enough that we could have allowed the company to remediate the issue and work through different processes. Or we have failed to, on the supervisory side, come to the point where the company is able to remedy this. And therefore, we are resorting to an enforcement action. And in either case, on the regulatory side, we need to take a look at those tools and to use them appropriately. It's not about public shaming. It's not about this or that. It's about truly getting the company to the right place if we're unable to get there through supervisory mechanisms. And I'll add one more thing, because I think we're running out of time. Speaking of how fragmented our regulatory framework is, Joseph and I had an opportunity with some of the other banking and market regulators to talk to some of the CEOs of large banks a few weeks ago. And one CEO basically said, you are asking me for my cybersecurity, compliance program for the bank. You are asking me for my same type of a program for the holding company. You're asking me for, for the purposes of my broker dealer. You're asking me for the purposes of another entity. And he goes, so for all of you, these are individual programs, and you're asking me for data, and you're asking me how I'm managing cybersecurity risk. But for me, it's one company and it's one cybersecurity, because a breach here is going to impact the rest of my company. So you are asking for something for data. Each of you is asking for different sets of data. And I'm producing data to all of you, and it's the same data in a different format. So there's quite a bit of coordination that can be done on the regulatory side. When we talk about smart regulation and how can we get there, it's really kind of a weeding through a lot of these issues to make sure that the compliance burden doesn't need to be more onerous than it is. And we should all look for safety and soundness and consumer protection issues. But at the same time, there's a lot we can do, kind of tweaking some of the rules and regulations to get to a more cohesive regulatory framework.
Good. Comptroller Otting, the last word.
So first of all, on the education, I really think it has to be community-based. And what you see often is organizations like Finance Park at Junior Achievement, where they bring young kids in, teach them about budgeting and expenses. Operation Hope that does bank in a box, where they bring people in. If you really think it's somewhat of a travesty when people get to be a young adult and that credit card shows up in the mail, they go out and use it. Next thing they know, they can't afford it and pay for it, and they destroy their FICO. Their FICO becomes 580. For the next really 8 to 10 years of their life, it has a meaningful impact of what it is like. And I think the more organizations that we can get banks and others to support through CRA to step back into that cycle and say financial literacy is just as important as physical education, as math and science, I think culturally we have to shift that. And I think that'll be a monumental thing if we can accomplish that. So. And then last of all, I would just say thanks for coming to the conference and listening. This has been a rewarding experience every time I've come here. It's amazing, Mike, how much expansion has happened really over the last 10 years and the thought processes that are brought together by this conference. So congratulations.
Here, here.
Man, thank you.
Yes, thank
All right,
you.
thank you all for a great panel. Thanks.